Hello, it's Richard Bowser here from Property Investor News. I'm here at the Excel Centre in London at the Property Investor Show, October 2017. And I'm here with John Corey, who's well known to readers and subscribers of Property Investor News. Good afternoon, John.
Afternoon, how are you?
I am fine, and John and I have just completed a panel debate at the show, and we were talking about property development and in particular financing your development. So we had about 35 people in the room, and we had a couple of other panelists with us, Paul Higgs and Shojin, a funder, and yeah, really interesting debate, John. Did you find that the case?
So I think there was a few things. There were some people who were developers, or currently are. There are some people who want to be developers, and there was also a number of landlords or individuals that fit the profile maybe of a more passive investor, and they were curious about the opportunities.
Yes.
Because there was this sort of angle about development is maybe the big thing right now, but can I do it without actually having to get a shovel out?
Indeed. Yeah, no, quite. So funding developments or part of the planning process as well, and then let somebody else maybe pick up a shovel. So we discussed where the marketplace is at in terms of in the autumn of 2017, and obviously some of the activity around London is a little bit subdued in comparison maybe a few years ago. Well, we've got locations like in Manchester, maybe, where things are much warmer in terms of interest in the market, and a lot of development is going on, and anybody that's been to Manchester of late would know that. Birmingham also, and some of the other regional cities. We also talked about financing developments. John has been interviewed by me and also in the magazine in terms of crowdfunding. So are you seeing much more interest now, John, in terms of crowdfunding developments?
So the simple answer is yes, but I think there's quite a learning curve.
Yeah.
So I work with individuals who want to get their campaigns funded, and there's quite a slow process sometimes for them to get their head around it.
Yes.
And it's not a reflection of the individual, it's just that it's quite different than what they're used to. So I think we're still at very early stages when the light bulbs are going on.
Yep.
It's the classic conversation is crowdfunding has the word funding in it, but crowdfunding is also about building your brand. It's about building a track record. It's about becoming known. It's about legally advertising what you're doing in a way the FCA is okay with.
Yeah.
And all of those sort of soft benefits aren't in the word funding. And people start to see that, and it's like, oh my God, so I can really share and tell my friends, I can get the word out, and I can raise money for my deals.
Yes.
And I can raise money for multiple deals over multiple years.
Yeah.
Then the penny starts to drop, and it gets quite interesting when people say, okay, now I get why I should do this.
Okay.
Now I get why I should sort of go forward.
Yeah. So there's a gestation process.
Very much so. Great word, yes.
Yeah.
Definite gestation period.
Yeah. But there's devil in that detail.
There's definitely devil. In fact, so one of the people I know, I didn't help them. They're quite competent. They have an investment banking background. They were able to get their deal organized for presentation to the crowd in about a day.
Right.
Some other people I have worked with, and maybe it's a reflection of me, they took 4 to 5 weeks.
Yeah.
It took a little while to sort of get all the information together, realize why it had to be documented in a certain way. I like to somewhat say this is actually like a public offering on the stock exchange.
Yes.
You're going public, you're making a financial fundraising effort. It's an IPO of a project. It might be an IPO of the company. So, who's the company? Are your SPVs in line? Have you got your bank account open?
Yep.
There's a lot of detail that it's like, oh, I didn't realize they had to do all that.
Yes.
There's a good learning curve.
Indeed. I mean, I did a panel here yesterday afternoon at the show when we talked about the PRA changes to mortgage lending for buy-to-let. And now if you're a portfolio landlord with 4 mortgage properties, you're going to have to go through a lot more scrutiny than you would have done a year or so ago. So I think people who are now either portfolio landlords or looking to transition into development have got to understand that finance is going to be now there's a greater degree of scrutiny perhaps than there was a year or two ago. Would you agree with that, John?
The PRA defines an amateur as anyone with 3 or less.
Yeah.
And they're largely saying 2 things. One is we don't expect you to know as much, and 2, we don't expect the portfolio to stand alone. You have a day job, and we're going to count on that a lot if there's a gap.
Yeah.
Once you get to 4, you represent significant risk.
Yeah.
We want the lenders to appreciate the risk that you represent to them, whether they've lent you the money in 1 or all 4. And we want them to do extra scrutiny. And it's like running a business.
Absolutely,
it's sort of
that's what I keep
up
saying.
to being a real business.
Yeah.
So I think it's fine. And it's a wake-up call to maybe the people who want to transition from I have a couple to I'm going to do this as a full-time business.
So basically, I suppose the message there is think like a Boy Scout and be prepared.
There you go.
Yeah. So, John, just 3 things to round off the interview with.
Okay.
What should people, three things that people should be thinking about in terms of property development finance to get themselves ready? What would they need to think about?
So one big one that people don't normally think of is you can do it in phases. You can fund just the planning. You can fund the first phase of development or some part of it. You can break down the project and de-risk it by staging it. You can also build your community and build your track record with the funding sources. Second, less debt, more equity. That if you don't want to have a problem with the economy slows, then don't be first on the list when the lender's calling loans.
Indeed.
You want to be able to reduce the pressure to have to deal with it. Third is, for a lot of people, in some sense, behind your question is if you're getting started in development, partner up with someone on your first deal or two. You don't have to do it by yourself.
Quite.
Leverage their expertise, leverage their track record, their knowledge of who to get funding from, and de-risk that whole first thing. And be less worried about how much you make on it and more about how much you benefited from being on the project.
Great advice, John. Okay, so it's Richard Bowser from Property Investor News here at London's Excel Centre with John Corey from Property Fortress. John, as always, thanks for your time.
Thank you. See you around, Richard.
Indeed. Thank you.